Welcome to this video. Today we talk about bank guarantees. We will try to gain an understanding in a comprehensive fashion as to how this financial instrument helps in modern business. We will try to have a look at the foundations, the characteristics and the applications of guarantees both for domestic trade as well as international trade. We will examine how the guarantees foster trust between the parties involved, how they mitigate the risk, how they facilitate cross-border trade. We will try to gain an insight into the critical role that the guarantees play in ensuring trade happens in a trusted fashion. What are bank guarantees? A bank guarantee is a written commitment issued by a bank on behalf of its customer, the applicant, to pay a specified amount to a certain beneficiary if the applicant fails to fulfill their contractual obligations. The guarantee serves as a financial safety net, a security, to ensure that the beneficiary is well compensated in case of non-performance or default by the buyer. So the guarantee is technically a three-party agreement, though within the guarantee you will see only the issuer, guarantor and the beneficiary. The applicant is the one who triggers or requests for or needs a guarantee to be issued. The applicant seeks to establish the credibility, and for that he seeks the help of the bank. Applicant can request their bank to issue the guarantee to transfer the risk of non-performance from the applicant to the bank, a trusted financial institution. So guarantee is a written commitment. Mostly it is on behalf of a bank. Sometimes it can be on behalf of corporates or insurers, etc. also. They are issued on behalf of the applicant. It has a certain amount indicated. It has a certain beneficiary mentioned over there. And that beneficiary will gain the benefit or the right to claim under the guarantee if the applicant of the guarantee fails to fulfill the contractual obligation. So guarantees serve as a risk mitigation. They reduce the risk of applicant non-performance. They provide a safety net for the beneficiary because there is an assurance for payment from a trusted third party. So guarantees foster trust, especially in cross-border trade where the parties are not known to each other, but banks are reliably known to each other or dependable. Sometimes there are no relationship between the parties, and so there is a need for the bank to guarantee the transaction. So the purpose is risk mitigation, trust building and financial security, for which the guarantees are normally being issued. Let us look at the origins. Historically, guarantees have been used in an informal fashion to build trust in trade, especially in cross-border trade, where relationships are non-existent or relationships are new or weak. The need for guarantee has also given rise to standardization of the guarantee, because the guarantees evolved over time in the form of a formalized instrument in written fashion, and so whatever is in writing used to have certain country-specific standards, and then it became to be governed by standard rules so as to ensure consistency and enforceability in different jurisdictions. Also, the International Chamber of Commerce had come out with URDG, Uniform Rules for Demand Guarantees, publication number 758, which provides a global framework for demand guarantees mostly issued by banks. They provide clarity, standardization and independence aspects. Then you have the ISP, International Standby Practices 1998, which governs the standby LCs, which are akin to guarantees, and they are widely used in United States and the other friendly regions. Guarantees are now used across industries, across sectors, across different types of corporates, be it construction or manufacturing or trade or projects. Guarantees can be adapted or enforced in a variety of situations, and so it has become indispensable in global commerce or global trade or cross-border trade. Now, as guarantees originated at informal agreements, there was a need to make it in writing or make it standard and uniform, and to have frameworks which everybody will understand in the same fashion. Today, guarantees are also being taking the form or shape of a smart contracts as per blockchain innovations. So this reflects the complexity of the trade, the need for the market, and the demand for a reliable risk mitigation tool, and something that can be depended upon and traced. So promises between merchants has become a sophisticated financial instrument today, regulated by commonly accepted rules across. Looking at the key characteristics, they are independent. That means guarantees operate independent of the underlying contract between the buyer and seller. Payments are not contingent upon the availability of funds with the applicant. Payments are not associated in any way with, positively or negatively, the disputes in the underlying agreement, or contingent upon any happening in the underlying agreement. The payment is based on the demand, that is a claim. So guarantees are payable upon presentation of a compliant document claiming the payment, and not necessarily the proof of default or proof of failure to perform. The demand or the claim is based on the concept that the beneficiary will get timely compensation. The commitment from the issuing bank is irrevocable. That means once issued, the guarantee cannot be revoked or amended or changed without the mutual consent of the parties involved, especially the beneficiary. This provides legal protection to the beneficiary. Suppose a supplier requests for an advance payment guarantee to ensure the buyer that the advance payment will be used for the intended purpose, or if not so, will be returned, then you give rise to a situation where advance payment guarantee comes into picture. The guarantee is irrevocable and it will be payable upon the compliant demand. So guarantees operate independently. They provide legal protection because they are irrevocable, and payment is against compliant demand. So this helps to build trust, because between the buyer and seller, the trust is inadequate or the risks are high. The obligations are separate from the underlying contract, and the disputes in the underlying contract will not affect the guarantee. So this also provides the comfort that the beneficiary is looking for. Looking at the differences between bonds and guarantees, bonds are financial instruments used in construction or infrastructure products, usually to ensure performance. They are conditional payment terms, which means payments are contingent upon proof of default or performance failure. Usually bonds require proof of default or performance failure. They are mostly used in construction or infrastructure industries, and they are mostly provided by contractors only in most of the geographies. While guarantee are used in all the geographies, and it can be used by all sectors and all industries and all parties, while bonds are specific to construction in certain geographies or infrastructure projects. Guarantees are broader instruments. Guarantees are not conditional, that is, evidence of default or evidence of non-performance or proof of failure is not necessary in a guarantee, while in bond normally that is called for. Now bonds are usually bound by local laws, while guarantees are bound by URDG or ISP. So this difference is crucial because the buyer and seller will have to decide which instrument they will choose for their specific situation. Both offer protection. Both are payment mechanisms, but guarantees are stronger security because they are unconditional and they have governance frameworks. Let us look at the importance or the need for standardization. First thing is clarity. Why there is a need for standardization? To ensure consistent interpretation during the execution of the guarantees in different jurisdictions, in different contexts, by different types of industrial corporates. Another need for standardization is enforceability. That is the legal recognition, and so that there is a reduction in dispute or easy settlement of the litigations because the terms are properly defined, the conditions are properly interpreted. Standardization also helps in global acceptance because it facilitates seamless use of the instrument and the rule because of the availability of common understanding. ICC played a pivotal role in standardizing the guarantees. The URDG 758 has come in after taking the feedback from various stakeholders in the industry. ISP 98 is still well accepted because it provides the legal requirements for enforcing a standby. So the definitions, the interpretations, the guidelines on how it will be issued, how the claims will be handled, how it can be amended, when the liability under the guarantee will be terminated are all clearly defined. So this has reduced the ambiguity. This has helped a cross-border transaction because people in different jurisdictions, different languages, different rules or legal framework can understand and reliably trust the instrument because of the consistency in the interpretation of the terms used. Now let us look at the various types of guarantees. What are the various types of guarantees? Performance guarantee is one popular type of guarantee which assures payment for non-performance, for example, completion of a project. Bid or a tender bond, they protect the bidders protect against the bidders who withdraw. That is, the paymaster will get the payment if after awarding a contract, a contractor fails to sign the contract or provide a performance guarantee. Advance payment guarantee, they are made to suppliers or contractors, and these advance payments, when they are made to suppliers or contractors, they are expected to supply or perform, and if they don't perform, the person who paid the advance payment will have a right to recover using the advance payment guarantee. These are some of the simple scenarios where different flavor or type of guarantee is used in a different situation. Let us also look at the life cycle of a guarantee. Coming to life cycle, first the parties agree that guarantee will have to be provided under an underlying contract. The applicant will approach their bank for issuance of the guarantee. The issuing bank is called the issuing bank or a guarantor, and they will provide the guarantee. They will indicate what is the underlying transaction, how much amount will be paid, who is the beneficiary, and what should be indicated in the demand. The assessment, the bank will evaluate the application and issue the guarantee. Once the guarantee is issued, it is irrevocable and only beneficiary has a control and title over the document. Beneficiaries can claim under the guarantee provided the claim is compliant with the guarantee terms. Payment will be made without any questions being asked by the guarantor. Most of the guarantee will expire without any claim. It will terminate on the expiry date or upon happening of an expiry event indicated in the guarantee. Some of the guarantees are also returned for cancellation. The bank is an important party in the guarantee because bank is liable to pay the moment a compliant claim is presented. The bank will have to agree for the amendment request by the applicant and beneficiary because changes in the contract may make it more risky for the bank to take that risk. Banks will have to process the claim and pay immediately when they find claims are compliant as per URDG rules and the guarantee text. So this efficient process of the role the bank plays in guaranteeing payment on behalf of the applicant for their failures to the beneficiary who suffers a loss is what makes guarantee acceptable. Let us see some examples where guarantees are used. In a construction industry, performance guarantee can be used to ensure contractors complete their projects as per their specifications. Advance payment guarantees can be used to ensure advance payment is used for the contract or returned. In international trade, shipping guarantees can be used to release the goods before the BL is cited by the carrier's agent at the destination port. Payment guarantees can be used to ensure the supplier gets their payment. It can be used in open account transactions. Also, to ensure if the payment is not made under open account, they will claim under the guarantee. In manufacturing industries, warranty guarantees can be used to ensure assurance that the product or service will meet the specified behavior or a standard over a period of time agreed. Performance guarantee will help timely delivery. So these are some of the practical applications, and guarantees are versatile instruments. They can be used in different industry for different situations in different sectors. By understanding these, it will be very helpful for the businesses to leverage these instruments to mitigate the risk and build better relationships. Key takeaways from this course is that guarantees serve as instrument for protecting the interest of the beneficiary. Frameworks like URDG ensure consistency, enforceability, and trustworthiness of the instrument. Current day digital transformations makes it possible through blockchain and other mechanisms to have a digital guarantee where it is very simple and there is only one original, and it is always accessible to all the parties to know what is the current status and what can be claimed. These instruments are fundamental. Guarantees of different types are necessary for facilitating trust between the buyer and seller across the border because they do not know each other. The standards like URDG or ISP helps to ensure different jurisdictions, different legal frameworks, different cultures, different languages. Irrespective of that, people understand, define, and interpret the guarantee in the same fashion. Guarantees issued by banks, because they are irrevocable and payable on demand, remains a trusted instrument and invaluable for cross-border trade. So these bank guarantees provide efficiency, reduce the risk of fraud, and enhance the transparency or security of the trade, reliability, or the collateral requirement. And these characteristics makes it the best tool for risk mitigation. Thanks for watching this video. We shall meet again in the next session on another subject.